In every boom, people convince themselves the system is stronger than it really is. Debt looks manageable, leverage looks smart, housing looks safe, stocks look unstoppable, and concentrated markets look efficient. Then one shock arrives: a rate hike, a bank failure, a war, an energy spike, a credit freeze, or a wave of panic. And suddenly everyone learns the same lesson at the same time. A crash does not only wipe out money, it exposes who was never truly safe. Welcome to Wealth Code, where money, power, and history collide, and nothing is ever as simple as it looks. Most people think surviving a financial crash means predicting it, calling the top, selling before everyone else, buying the bottom like a genius, and walking through the ruins with perfect timing and a calm expression. That is the fantasy. History is far less elegant. Most people do not predict crashes. Most professionals do not predict them reliably either, although many become remarkably confident afterward, which is one of finance's oldest magic tricks. The real question is not, can I call the top? The real question is, can I survive being wrong? Because crashes punish people less for failing to predict the future than for building a life that only works if the future stays perfect. The first hard lesson is that paper wealth is not the same as real wealth. In the late 1920s, the American stock market seemed unstoppable. Ordinary people, bankers, brokers, and industrialists all believed they were living through a new age of prosperity. Stocks rose, credit expanded, and margin debt allowed investors to buy shares with borrowed money. Wealth felt real because rising prices kept confirming the story. Then came 1929. The crash began in October, and over the following years, the Dow Jones Industrial Average fell almost 90% from its peak. Fortunes disappeared, not slowly, not politely, but like a trapdoor opening beneath the economy. The lesson was brutal. A market price is not the same as survival wealth. If your fortune depends entirely on what someone else is willing to pay for your asset tomorrow morning, you are not as safe as you think. That does not mean stocks are bad. It means paper gains are fragile when they are built on leverage, mania, or the assumption that buyers will always be there. Holding quality assets through a crash can work if you are not forced to sell. But holding a collapsing speculation is not courage. Sometimes it is simply denial with a brokerage account. The crash does not ask what your portfolio was worth last year. It asks whether you can survive this year. The second lesson is that liquidity is power. Cash looks boring during a boom. It sits quietly while everyone else brags about returns, property gains, crypto profits, stock options, and whatever asset happens to be worshipped by people who discovered finance 6 months ago. But in a crash, cash changes character. It becomes oxygen. It gives you the ability to pay bills, avoid forced selling, buy time, negotiate, relocate, repair, wait, and act while everyone else is trapped. During the Great Depression, households without savings lost farms, businesses, homes, and dignity. In 2008, when the housing bubble burst and credit markets froze, people with liquidity could survive layoffs, hold onto their assets, or buy distressed property and stocks after forced sellers had been wiped out. The same asset that looks cheap during a crash is only cheap to someone who has cash. To everyone else, it is just a number on a screen they cannot use. In good times, liquidity looks lazy. In bad times, liquidity looks like power. The third lesson is that debt turns a downturn into a trap. Debt is calm during the boom and violent during the crash. When incomes are rising and asset prices are climbing, debt feels like leverage, ambition, and optimization. Borrow to buy more. Borrow to grow faster. Borrow because prices only go up. But when prices fall or income disappears, debt becomes a machine that makes decisions for you. It does not care that the crash is temporary. It does not care that the market may recover next year. It wants payment today. In 1929, margin calls forced investors to sell into a falling market, accelerating the collapse. In 2008, mortgages, adjustable interest rates, falling home values, and job losses trapped millions of households. People who believed they owned homes discovered that ownership with too much debt can become a countdown. Businesses burdened with heavy debt cut workers, sold assets, or failed because creditors do not wait for confidence to return. Debt removes flexibility precisely when flexibility matters most. A fixed rate mortgage on an affordable home can be useful. Productive business debt can create wealth. but high leverage tied to unstable income or inflated assets is one of history's most reliable financial killers. The fourth lesson is that income matters more than valuation when the system breaks. In a boom, people ask what you own. In a crash, they ask what still pays. Your house may be valuable, but can you afford the mortgage? Your investment portfolio may recover one day, but can you buy groceries today? Your business may be worth millions on paper, but is cash still coming in when customers disappear? A crash cuts through vanity and asks one simple question: what continues producing income when the story changes? During the Great Depression, people with stable employment, practical businesses, productive farms, or strong community networks often proved more resilient than those who were wealthy only on paper. During the COVID-19 shock, remote workers, government employees, essential workers, and businesses with durable cash flow generally weathered the storm better than people tied to fragile industries such as travel, hospitality, or a single vulnerable employer. That was not moral superiority, it was exposure. In a crash, net worth means very little if it cannot be converted into survival. Cash flow becomes the heartbeat. The fifth lesson is that useful skills become a form of wealth. This is not romantic, it is practical. When formal systems weaken, usefulness becomes currency. During the Great Depression, families repaired clothes, grew food, preserved harvests, rented spare rooms, moved for work, traded favors, and stretched every resource because survival depended on adaptation. From post-Soviet economic disruptions to Argentina's repeated financial crises, people with repair skills, medical knowledge, food production, trade experience, sales ability, logistics expertise, or trusted relationships consistently had more options. Skills are wealth that cannot be marked down by the market. A stock can lose 80%, a currency can collapse, a house can become impossible to sell. But the ability to fix, cook, grow, repair, teach, care, build, organize, negotiate, sell, code, or adapt remains valuable. Financial education is not only about assets, it is also about capability. When money becomes nervous, usefulness becomes currency. The sixth lesson is that diversification is not boring, it is anti-ruin. Booms reward concentration, crashes punish it. Japan in the late 1980s looked unstoppable. Stocks and land prices soared. Tokyo real estate became a symbol of financial insanity disguised as national destiny. Then the bubble burst. Japanese stocks and property entered decades of stagnation, and investors who believed one country, one asset class, or one story could rise forever learned how expensive certainty can become. The dot-com crash repeated the lesson. Technology truly was the future. But being right about the future is not the same as paying the right price for it. Many investors concentrated everything in one sector, one story, and one wave. When the bubble burst in 2000, companies disappeared, valuations collapsed, and the Nasdaq lost most of its value before eventually recovering years later. Some winners survived, many did not. Diversification rarely makes you sound brilliant at parties, but it prevents one bad assumption from destroying everything. The seventh lesson is that there is no universal safe asset. There are only assets that are safe from specific dangers. People love simple answers during crises. Buy gold, hold cash, buy land, own stocks, own dollars, own Bitcoin, own canned beans. History is more complicated than slogans. Different crises punish different forms of wealth. In deflationary crashes, cash can be powerful because prices fall and liquidity disappears. During inflationary crises, cash can quietly lose purchasing power. During currency crises, gold, foreign currency, real assets, and portable wealth may offer better protection than local cash. During banking crises, where your money is held matters just as much as how much you have. Gold can protect against monetary distrust, but it produces no income. Real estate can hedge inflation, but it can also become illiquid, heavily taxed, tightly regulated, or impossible to sell. Stocks can recover after crashes, but only if the companies survive and you are not forced out at the bottom. The right survival asset depends on the threat. The eighth lesson is that the people closest to the state are often rescued first. That is not how the system is advertised, but history suggests it is often how crisis politics works. In 2008, governments and central banks rescued the financial system because its collapse threatened everyone. The logic was understandable. The distribution was revealing. Banks received liquidity, markets received support, large institutions were stabilized, Households often received help more slowly, more unevenly, and sometimes too late. The people who started the fire were not necessarily the ones sleeping outside afterward. A similar pattern appeared during the COVID crisis. Governments acted quickly, but the benefits flowed unevenly. Large firms with legal teams, banking relationships, political access, and administrative capacity often navigated emergency programs far more easily than small businesses or informal workers. In a crisis, the first question is not always who deserves rescue. It is who can threaten the system by failing. Financial freedom begins with knowing whether you are protected by the system, exposed to the system, or invisible to it. The ninth lesson is that panic is expensive. Holding through a crash can be wise if the asset is high quality, your time horizon is long, your position is not leveraged, and you have enough liquidity to survive unemployment, bills, and fear. But holding is not magic. Markets can recover long after you have already gone broke. That distinction matters. Many investors sold near the bottom in 1929, 1987, 2000, and 2020 because they were terrified, over-leveraged, or simply needed cash. Sometimes selling was rational. If rent is due, food is needed, or your business must survive, ideology means nothing. But panic selling quality assets after large declines can lock in losses that patience might have avoided. The problem is that patience is only available to people who are not forced. If debt, unemployment, medical bills, or poor planning force you to sell, emotional discipline no longer matters. The market does not reward bravery after your liquidity runs out. The 10th and final lesson is that the real survival asset is optionality. Optionality means having choices when other people have none. Cash creates options. Low debt creates options. Skills create options. Reliable income creates options. Diversification creates options. Trustworthy relationships create options. Mobility creates options. Good health creates options. Insurance, legal protection, reputation, and emotional control all create options. The people who survive crashes are not always the ones who predicted them. They are the ones who were not destroyed by being wrong. That is the lesson history repeats again and again. A financial crash is not merely a market event. It is a test of how much of your life depends on assumptions that only work during good times. Assumptions that your job is secure, that your house can always be sold, that your portfolio is always liquid, that your debt is manageable, that your business revenue will continue, that banks will remain open, that governments will rescue people like you. Some of those assumptions may prove true. The danger is needing every one of them to be true at the same time. Now look at the present. Households carry heavy debt. Housing remains expensive. Many workers are one layoff away from financial distress. Artificial intelligence is reshaping white-collar employment. Public debt continues to rise. Asset prices remain concentrated. Geopolitical conflicts can disrupt energy, food, and financial markets overnight. Inflation has already weakened purchasing power. Central banks remain trapped between controlling inflation and avoiding recession. The modern person is expected to invest, borrow, save, upskill, buy a home, prepare for retirement, tolerate volatility, manage debt, and stay calm, all within a financial system where shocks arrive faster than security. History cannot tell you exactly when the next crash will arrive. It can tell you what usually breaks first. Over-leveraged balance sheets break. Fragile income breaks, false confidence breaks, illiquid wealth breaks, concentrated bets break, political promises break, trust breaks, and when trust breaks, everything that once looked permanent suddenly becomes negotiable. So what actually survives a financial crash? Not hype, not blind optimism, not leverage disguised as confidence, not paper wealth dependent on perfect timing. What survives is liquidity, useful skills, low debt, diversified assets, durable income, trustworthy relationships, and the ability to avoid forced decisions. Quality assets can survive, but only if their owners survive long enough to keep them. Gold can help, but not in every crisis. Cash can save you, but not during every inflation. Real estate can build wealth, but not when debt turns it into a trap. Stocks can recover, but not if panic or necessity forces you out before they do. The final lesson is simple and uncomfortable. You do not prepare for financial crashes by pretending you know the future. You prepare by building a life strong enough to survive surprise. Because every crash humiliates certainty. It punishes arrogance. It exposes leverage. It separates price from value, wealth from income, and optimism from resilience. Financial freedom is not about never being hit by a crisis. That is impossible. It is about making sure that when crisis arrives, it does not get to make every decision for you. A crash does not ask how much money you made during the boom. It asks how much freedom you kept when the boom ended. If this perspective changed the way you think about money, history, and risk, make sure to subscribe to Wealth Code and turn on notifications so you never miss our next deep dive into the hidden patterns that shape wealth, markets, and power. Remember, the future is uncertain, but the lessons of history are not. Study the past, prepare for the unexpected, and build wealth that can survive any storm. Until next time, keep learning, keep thinking, and keep building your wealth code.